Today, we're diving into the Oracle of Omaha himself, Warren Buffett, and the jaw-dropping $325 billion of cash he's stockpiled. Why is Buffett selling off massive portions of stocks like Apple and Bank of America? Why did he freeze buybacks despite Berkshire stock hitting record highs? And most importantly, does this mean that a market downturn is coming? Hi everyone, I'm Steve, and on this channel we dive into all things stock market and finance. Stick with me as we unpack these questions and uncover what Buffett's moves might mean for all of us. Let's start with the numbers. By the end of September 2024, Berkshire Hathaway's cash pile hit a record $325.2 billion. This marks one of the largest cash positions in the company's history. So where did all of this cash come from? For 8 consecutive quarters, Buffett has been a net seller of stocks, offloading a staggering $166 billion worth of equities over the past 2 years. In the third quarter alone, Berkshire sold $36.1 billion in stocks, including trimming a quarter of its Apple holdings and selling over $10 billion of its longtime Bank of America investment. So why is Buffett selling? Apple and Bank of America have long been staples of Buffett's portfolio. So why is he trimming these giants now? One reason could be diversification. Apple alone has grown to represent more than 40% of Berkshire's equity portfolio, an outsized position even by Buffett's standards. Some analysts have pointed out that reducing this stake is a prudent move given how much Apple's valuation has surged. Another reason might be market valuation. The cyclical adjusted price to earnings, or CAPE ratio, also known as the Shiller PE ratio, is sitting at a lofty 36, more than double its historical average. Historically, CAPE ratios above 30 have often preceded significant market corrections. And as we all know, Buffett is known for his buy low, sell high philosophy, and I'm betting in his eyes, this market is anything but cheap. So what is Buffett doing with all that cash? Instead of reinvesting in stocks, much of it is being parked in short-term US Treasury bills. Why? Because they offer low risk and high yields in today's environment. In fact, Berkshire earned nearly $10 billion from these investments in the last quarter alone, making it a smart play for a cautious investor like Buffett. Berkshire didn't repurchase any of its own shares in Q3 2024, a notable shift given the company's history of aggressive buybacks. The reasoning? Well, Berkshire states that it will only buy back shares when Buffett believes that the repurchase price is below the company's intrinsic value. And with Berkshire stock hitting record highs and even crossing the 1 trillion market cap milestone, Buffett likely feels the current price isn't the bargain he's looking for. It's not just valuations that have Buffett cautious. Several economic indicators point to potential trouble ahead, like the inverted yield curve. The US Treasury yield curve was inverted for an unprecedented duration. Although it has recently reinverted back to normal, historically this is one of the most reliable predictors of a recession, signaling that investors expect weaker economic growth in the future. Next, we have declining M2 money supply. For the first time since the Great Depression, the M2 money supply, which is the total amount of liquid money circulating in the economy, has contracted. This could signal tighter financial conditions and reduced consumer spending. Then we have ballooning fiscal deficit. The US fiscal deficit has grown alarmingly, and notable investors like Paul Tudor Jones have raised concerns about its long-term implications. Buffett himself has hinted that rising capital gains taxes may become necessary to address the deficit, influencing his decision to sell off more of his holdings. And market optimism versus reality. While the market has rallied on expectations of a smooth economic landing, Buffett seems skeptical. The 10-year Treasury yield climbed back above 4% last month, suggesting that inflationary pressures and borrowing costs remain a concern. Buffett's strategy isn't about timing the market, it's about being ready when opportunity strikes. He's shown this time and time again. From his 2011 $5 billion investment in Bank of America to his bold moves during the 2008 financial crisis, with $325 billion in cash, Berkshire is perfectly positioned to pounce when price dislocations, as Buffett calls them, emerge. Here's what we can take away from Buffett's strategy. Number 1, stay cautious in overheated markets. Don't chase overpriced stocks or hype-driven sectors. Focus on companies with strong fundamentals. Number 2, keep cash reserves. Having liquidity gives you flexibility to act when the market presents real bargains. Number 3, focus on the long-term value. Buffett reminds us that patience and discipline often win in the end. Warren Buffett's moves are sending a clear message. He sees the market as overpriced and is preparing for potential turbulence. His $325 billion cash pile, stock sales, and pivot to treasuries aren't just cautionary, they're strategic. Whether or not a recession materializes, Buffett's long-term approach offers valuable lessons to all of us. If you want to check out another video about a stock that I feel has a bright future, then check out this video right here. Take care, and I'll see you next time.